All right, before we get started here, guys, I want to launch a quick poll question and just kind of get your opinion on how are you getting flexible this year to combat those high renewals that maybe you yourself as an employer are seeing or your clients are seeing? Are you increasing employee deductibles? Are you introducing a health savings account? Have you, pitched an HSA, driving wellness engagement, funding the health plan differently than you have done before in the past? Take into consideration all of these different ways that you can get flexible and let us know what you're doing. I'll give everyone just a couple more seconds here, and then I'm going to tease you a little bit with the results. I'm going to save them for later in the presentation. So I'm going to pass it over to you, Rosa, to get started.
Thank you, Taylor. It's really exciting to be here. As we think of health insurance, when I think of employer-sponsored health insurance, it's not lost on us that there's competing demands on employer groups and companies. And on the one hand, benefits cost so much to employers. It's a huge line item in our budgets, a huge part of our expenses. And as employers, we're measured in really specific financial ways, right? There's EBITDA goals and growth goals. And the increasing cost of healthcare makes it really challenging for employer groups to think of that line item in a budget without having to also think about how do I create cost containment strategies to make sure that I can continue to have this line item that I have to provide my employees and do so in a way that is cost effective and doesn't put the rest of my financial objectives in an organization at risk. And on top of having those goals, for some employers, they're facing cuts because budgets are shrinking or revenues are declining. And so there's this whole financial component that employers are looking at in terms of healthcare and providing healthcare to their employees. On the other hand, we have the, healthcare is part of what we offer as an employer, similar to compensation and similar to culture. And we are using, one of the ways in which we use healthcare is to compete for talent. We want to retain and attract wonderful employees, and they want and demand great benefits. We need those wonderful employees to help us solve those problems on the left-hand side, right? And as we think of, that goal of talent, we are in the midst of the quote unquote great resignation, where 40% of workers are considering leaving their jobs, according to Microsoft. That's tremendous. And, we see that in August, 2.9% of Americans quit their job, more than in any other month since the data has been tracked in 2020 when it started. And so, we think of these two things and say, wow, on the one hand, benefits are critical and mission critical for us to be able to attract our employees and providing really great benefits represent in some way our brand for employees, right? If they're working with our clients and our members and customers, we want to make sure that they feel that they work at a great place and that there's high quality of what we're delivering. And on the other hand, we have a responsibility to make sure that we're doing so in a cost-effective way. And so, as we think of these strategies, we can look at the competing demands, and then we have to look at the outcomes of what we're spending on healthcare and the objectives that we have. And so if we look at the outcomes, it's really kind of horrifying if you think about employer-sponsored health insurance for a member experience. It's pretty horrifying. And so we have, 30% of Americans who've skipped a prescription. We have 40% that skipped a medical procedure. Deductibles are increasing 111% in the last 10 years, and this is all according to Kaiser Family Foundation. That's, a tremendous increase. When we think of, the financial component of healthcare and moving those deductibles up, At the same time, we know from the Federal Reserve, a study that was done in 2018, that about 40% of Americans do not have enough cash or credit on hand to cover a $400 emergency. So now our employees are moving into higher deductible health plans, but the cash isn't on hand or the credit, candidly, to save or pay for those expenses, which is going to create additional constraints for our members. And there's been a study that was published recently that a couple will need $300,000 in retirement to pay for medical expenses. And so as we think of healthcare and health insurance that we're providing our employees, the outcomes are candidly not matching our investment. If you think about what you pay for health insurance to an employee could be as much as what you pay for a Disney vacation. There's very different expectations of what those outcomes are. And in some way, when we think about health insurance, those expectations based on how much we spend should not include getting bills that are incorrect, right? You should not get a $20,000 bill by accident or because your doctor has not yet submitted to insurance. The first experience that you have with care and providers should not be concerns about whether or not you can pay for it or concerns on quality of care. Based on the investment, we should have really special and significant outcomes for our members and our employees. And it's just not there. It's really not. And I think of my own, healthcare is personal. So I think of my own family, and 9 years out of 10, I'm in the part of the consumer experience where I barely spend anything on healthcare. I'm very lucky, knock on wood. But every 10 years, I have a significant expense, and I end up spending a ton of time, effort navigating health insurance. And I'm a really educated consumer. I've been in this industry for over 20 years. So I understand what these words mean, and deductibles and co-insurance, right, as opposed to employees. And I just think, from the amount of money that we are paying into health insurance, we should have a different outcome. And as an employer, we needed a different strategy. And Chris, I think you have some considerations on the employer perspective.
Yeah, Rosa, you make some great points from an outcome perspective. And I think we all as an employer are facing this issue with the Great Resignation, right? So we've got tough outcomes, we've got issues with employee retention, and we still have this problem of rising healthcare premiums. And this is a problem that's been going on for the last 20 years. For the last 10 years, it's risen by 160%. Compare that to inflation, and it is way, way out of whack. So this is a problem that has been going on for years. We did get a little bit of a break last year, right? I think the 1/1 renewals that you all were looking at in 2021 were not as bad as what we're faced in the past and what we're about to face now for 1/1/22. But this is exacerbating that problem that employers are facing. They know the outcomes are not good, but they're still getting hit with these big rate increases year over year. So they're stuck to some extent, and they need to start thinking in different ways and finding creative, flexible solutions to address this problem. So again, we had a little break last year, right? 1/1/21 wasn't as bad from a renewal perspective. So far, what we've seen in the small to mid-sized business for 1/1/22 is a return to that increase and that spike in health insurance premium. The previous slide was from the Kaiser Family Foundation. This slide is from one of our brokerage partners who did a survey of their block of business. And what they're seeing is a 28% increase in small to mid-size renewals on the fully insured side of the house. So that is really a tremendous bounce back, right? We're all seeing that COVID bounce back in claims, and now it's starting to show up in big, big health insurance increases. So we've focused on the problem. We're now going to start to shift to, well, what are some of the solutions? And there are a lot of solutions out there. There's a lot of different ways to address the problem. And as a consultant, you all are looking at all these different ways and different competing ways to address that problem of rising health insurance costs. So we recognize that there is a lot out there, from fully insured insurance to level funded to self-funding, buying a captive, or even direct contracting with hospitals, are tons of different solutions. And the difference card solution kind of fits in that limited risk. It's not quite fully insured. It's one step up closer to self-funding, but we recognize that there are a lot of different solutions out there. What we're going to focus on for today's presentation is really the funding solution of this. How can I use medical expense reimbursement plan gap funding to lower renewal increases and set a long-term strategy? And how can I pair that with wellness programs and account-based plans like a health savings account? So we're going to focus mostly on the funding approach today. We're going to talk a little bit about health savings accounts. And in future webinars, this is a three-part series, remember, we'll dive deeper into the wellness strategies and some of those account-based strategies as well. All right, so before I get into our case study and I start revealing some of the strategies that we as an employer have used, Taylor, you want to show the answers to the poll?
Yeah. So this was interesting. We had a really good mix of responses. 22% are increasing the employee deductibles. 22% have introduced an HSA. We've only got 13% that are driving wellness engagement, and 43% of respondents are choosing to fund the health plan differently. So you're in the right place because we're going to talk about how to do that today.
Yeah, that's really interesting. So 43% of you are already starting to fund the health plan differently. And that's what we're going to talk about today. Even if you've already started introducing a level of gap funding, or maybe you have an HRA and a customer today, you're starting to fund the plan differently, there is still a lot more you can do. And that's what we're going to focus on today. So this case study is our own company. We wanted to share the results. We just went through our November 1st renewal, and we're a 95 employee company. We've got almost 90% participation, 83 people on our plan today. And what we've done in the past is we've introduced a very simple single option EPO design. We had a high copay, high deductible plan that we used the difference card MERP to fund. And the end result was low copays to our employees and a $500 deductible. But over the past 2 years, so looking back a year and this renewal, we've received double-digit increases. We got an 11% from United Healthcare 2 years ago and a 12% from Cigna this year. So we've really, though, those were the initial renewals. I want to show you and showcase some of the strategies that we have implemented over the past 2 years to bring those double-digit increases down to actually negative numbers, so savings for our business, but better benefits for our staff. And that's really the goal, is to help address that employee retention issue by delivering better benefits, but at a lower cost. And then we'll also talk wellness a little bit. We'll probably focus on that in some of the future webinars a little bit more. So let's talk about some of the details. How do I reduce these renewals? We know you're faced with these double-digit increases right now. And one of the first things you can do is look to the funding strategy. So there always is a higher deductible you can go to until eventually you get to that ACA limit. But every year that goes up a little bit. So that's one of our strategies, is go to that next level. If we're at a $3,000 deductible today, let's go to that $5,000 or that $7,000 deductible to keep driving down the fixed premium as low as possible. The next phase of this is really where the multi-year strategy comes in. And Rosa's done a great job helping us to introduce an HSA paired with the medical expense reimbursement plan. So those two go together. And that's a strategy that a lot of consultants have not used yet. They've done MERPs and they've done HRAs and maybe they've done HSAs on the side, but putting them together is really unique. And that's something that we started introducing last year. We actually got 27% of our population to move into that plan, and that helped us to reduce the cost of our health insurance. And we started introducing some wellness incentives as well for annual physicals and flu shots. So now I'm going to share with you the results of how this actually worked for us. And this was last year's renewal. So we were faced with, as you can see here, about an 11% rate increase, which would have meant the business had to absorb $140,000 more in health insurance premiums, even though we already had some gap funding through the difference card in place. So we went back, we looked at lots of different carrier options, we looked at higher deductibles, And we ultimately decided to introduce that health savings account along with higher deductibles, but to our staff, we're making the benefits whole on the EPO side, and we're giving them some seed money into that health savings account to start setting them up for the future. And the result there was our cost actually decreased. So instead of the rates and the premiums going up by 11%, we were able to lower our cost to the 1.2 million range. That was a $90,000 reduction versus current, and over $200,000 off of that renewal increase. So instead of costs going up by 11%, they actually went down by 7%. So great results last year. And this was just our first step in our multi-year strategy. So the next component of this is a detailed benefit analysis, which you may see from one of our consultants as you're working through a difference card prospect discussion, or maybe a renewal with us. And this is the current plan design that we had today. So we were buying a $30 copay and a $3,000 deductible, and we were funding the copays. We were funding a lot of that deductible so that we were delivering a great benefit to our employees. And the problem we were facing was we were still getting an 11% increase on this underlying plan. So the rates were going up. So then what we did is we introduced this second option, which had a $6,000 deductible. So we went from the $3,000 to the $6,000 as an option. We didn't force people into it. We said, you can still buy the same plan we have today, but if you are interested in it, we have this higher deductible plan, and we're pairing that with a health savings account plus a medical expense reimbursement plan, so that the end result to our people was they're just paying the first $1,500 and they're going to get $600 of that paid in a health savings account. And then the rest of that deductible is funded by the difference card using that medical expense reimbursement strategy. And by getting 27% of our people to elect that option and making some funding changes, we were able to really significantly reduce that renewal. We were able to get below current instead of facing a double-digit increase. So just one step in our multi-year strategy of reducing renewals. So now here's step two, and here's year two in our case study, same group, still the difference card team. And this year we were faced with a 12% rate increase. So we didn't want to make a carrier change, and we wanted to continue on our journey of account strategy. So what we did first is we said, what if we just buy the high deductible plan for everyone, and we'll increase that deductible to $7,000. Cigna had an option that allowed us to increase the deductible further. It lowered our premiums. We put everybody into that base option, and then we built back to two different designs. And this is where the medical expense reimbursement plan is really important versus using like a traditional HRA. We're able to deliver two different plan designs from one base option. So we had a high plan, which was a 90%, 10% coinsurance split, really great benefits, actually a lower out-of-pocket, lower cost for our employees in that plan. And we were continuing the HSA strategy, but this year, because we saved so much money by moving to the higher deductible option, we were able to fully fund and give back $1,500 for an individual into a health savings account. And with that strategy, we now got 55% of our population to migrate into a health savings account. And then we continued the wellness strategy with physical and flu shot incentives. And we also introduced a strategy called Good Sell that we'll talk further about in one of our future webinars. All right, again, let's talk results on what happened in year two. So the problem we were facing was this 12% rate increase, another $140,000 more in health insurance premiums. And instead of just accepting that, and instead of just maybe tweaking the copays and deductibles a little bit, which we could have done, right? That's a common strategy that would have gotten us down to 5%. But instead, we went to this high deductible plan for everyone. So we lowered our fixed premium substantially, and our overall cost came down to 1.1 million. So it was a 3% decrease and $170,000 net reduction versus our renewal cost by implementing this strategy where we've got now a coinsurance plan as the high option, and an HSA plan that's fully funded, fully seated by the company in as the base core option. So let's dig into some of those details. This is, again, the benefit analysis of what this all looks like. And this is the high plan. So this is the plan you can use to replace the traditional copay type design, but still deliver that lower cost from day one, from $1 to employees. Because some employees are still scared about the high deductible type health plan design, and they want first dollar type coverage. So in this design, we buy a $7,000 deductible, and the difference card pays 90% of every claim. Then the employee pays 10% of every claim. So it's fairly simple. It's a 90-10 split. We pay 10% as an employee, the company pays 90%, and that's funded through the difference card MERP. And the end result is, for an individual, they only have to pay $700. That's their maximum out of pocket. And all along the way, they're paying small incremental coinsurance expenses. $100 doctor's office visit, that's going to equate to a $10 coinsurance charge for that one visit, to a maximum of $700. So that's the high plan strategy to replace the copay plan and drive down our costs for that option. And then we continue to offer the HSA design so that we can, again, have that triple tax advantage, all the great things that come with an HSA, and to drive that multi-year strategy of reducing healthcare premiums for our staff. So in this case, we bought a $7,000 HSA deductible. We are saying the employees are responsible for the first $1,500. That leaves it as a qualified plan. The company is going to contribute to that. We're actually fully matching the $1,500, and then the company's funding the back end part of the deductible as well. It's really a great benefit to our staff. So the net result was improved benefits at an overall lower cost for the staff and for the company. So with that, I'm going to let Rosa take you through how this flexible strategy helps us, not just in year one, but how that flexible strategy applies year over year. So Rosa, why don't you walk us through in a maybe simpler terms how this all works?
Sure. And also, I joined the difference card almost 2 years ago, right before COVID started in 2020. And as I was reviewing the benefit package to come to the difference card, one of the things I noticed is we didn't have an HSA, and it caused me pause before I accepted the offer to say, I would not go work someplace that did not offer a 401k or some form of retirement coverage. Am I really going to go someplace where I don't have that HSA where I can start building? And for me, healthcare is really personal, right? And I'm part of that sandwich generation. In 10 years, I'll have a kid in college, and both my parents, knock on wood, will be in a retirement home, and I'm going to be paying for that. And, that's a problem I'll figure out how to solve for in 10 years. But what I want to make sure I'm really not creating is that same problem for my daughter, right? And for my children. And so as we think of that why HSA, I think it's really personal for everyone. It's a little bit different. And those are the types of things that benefits can create strategies for retention. Now, when we think of benefits, every employer has a health plan, right? And a 401k, most have a 401k offering. And we start seeing synergies between those two different plans and those benefits that allow us to create some efficiencies and synergies in how we roll that out. So when Chris is talking about our employees now have a $7,000 health plan high deductible that they're going to have this year, that's a tremendous expense, and not something that being a great place to work isn't going to be affordable for most employees and would be significantly concerning. And so what we did is say, of that $7,000 for a single, the first $1,500 would be the employee's responsibility. And so the employee of that $7,000 for a single, they're going to pay the first $1,500. At the same time, we are going to put in an HSA, an employer contribution. And that employer contribution covers those HSA expenses, and we do it on a monthly basis so that we are mitigating our risk as an organization to make sure that we are contributing over the course of a year. And we're doing that for singles, the $1,500, for families, the $3,000. Now, just thinking of that HSA contribution, by shifting to the higher deductible, telling the employee that you're going to be responsible for the first part of that deductible, and then we're going to provide you an employer contribution. As you think of, the Federal Reserve study that so many people are familiar with, where 40% of Americans don't have $400 in cash or credit, and the deductibles increasing 111%, those two problems create this chasm for many Americans, and we automatically check that box by the end of next year for a good component of our employees who aren't going to have significant medical expenses. They can automatically, just by participating in the plan, have more than $400 in a savings for medical expenses should they incur that. And so we start thinking of strategies to say, how are we going to pair benefits with financial vehicles that improve our benefits, not just in terms of networks or critical conditions, but really thinking about the financial component of benefits as well. Now, in addition, we cap our employer contribution at $1,500. You could fund an HSA with more. We are capping it there, and additionally funding in the MERP or Section 105 plan the rest of the expenses on a high deductible health plan. And so the employee is paying for the first $1,500. We are paying through a MERP that second component of the deductible. And that way it's a promise to pay if the employee experiences those claims, right? If they don't experience those claims, nobody has paid for that expense, and that generates savings. Some organizations do that type of plan in an HRA. We do that in a medical expense reimbursement plan, and that works better for us and our employees. Now, in addition, of course, employees can continue to contribute pre-tax. And so we start seeing that parallel all of a sudden of our health strategy of saying we have this high deductible health plan, and we've paired it with an HSA where we're providing contributions. Employees can contribute pre-tax. We're protecting the exposure from our employees to make sure that they're truly not responsible for the first $7,000 of medical expenses. So we're creating this health strategy that really parallels to our 401k in many ways, right? And you're seeing some on screen, hopefully, some parallels that create some synergies for us. And so in that, we start driving a multi-year strategy that we can build on. And this is the part I think that for me is the most exciting to really think about taking a problem, right? Hey, I have this budget that I need to my boss demonstrate that we are meeting our financial goals and targets so that we can reinvest and continue to bring new products out to market, make sure that our employees are well taken care of. And on the same token, I need to provide really great benefits for our employees. And so these are two problems, quite frankly, in isolation that when I combine them together can actually create a positive for us. So the nerd in me just dropped some little math fun, but it's really exciting. And so when we thought about rolling this out, healthcare fluency is really low, and probably even lower is financial fluency. So we started in the fall of 2020 with education about what an HSA is. It was the first time we were introducing an HSA plan at the difference card for our employees. And so we did a lot focused just on what it is, why an HSA, and how they can be used in retirement, how they can be used before retirement, how employees can save money on taxes, it's different from some of the other traditional vehicles that have existed for a really long time in FSA. So really basic education and the what's in it for me type question of that HSA. And, we've been in this industry for a really long time, so we're able to kind of make sure that we're reviewing the regs and saying, and let's put in that compliant plan design that puts in that post-deductible MERP so that we can contribute to the HSA, but protect the employee out-of-pocket experience. We didn't stop in 2021. So as we had our open enrollment in 2020 for 2021 benefits, after that, first open enrollment where we saw 27% of employees picking the HSA, we continue to do education throughout the year. But we shifted the education we were doing to financial literacy education. And so we had someone come in and do a course for our employees on basic investing, on what index funds were, on CAGR, right? Compound annual growth rates, on mutual funds, on all the different topics that might be very common from an investment perspective if you're thinking about growing financially your own personal future. And we did it specific to our 401k benefit offerings or investment offerings and our HSA investment offerings, not providing advice, of course, but really explaining what these concepts were, what it meant for an employee, and what it could mean for an employee to put $1,500 in an HSA over 20 years. And they're really cool calculators that can show the difference between putting $1,500 in an HSA over 20 years and putting in $1,500 in an HSA over 20 years and investing those funds, right? And making sure that we were teaching and showing in an illustrative way what that could mean for our employee base. We did surveys after that. 50% of our employees made changes to their own finances within 2 weeks of attending that training. And we received such positive feedback that we then offered that same webinar for all of our members as part of our wellness program. So from an education perspective, in focusing on 401k, focusing on investments and just some financial literacy, we then actually made some changes to our 401k to do automatic enrollment as opposed to optional enrollment and automatic 1% contribution, and really started mirroring and pairing together the focus of benefits from combining health and 401k, health and wealth, to make sure that we're paired together for success. And that really set the stage so that in this past renewal, we could again increase our participation in the HSA and not increase our participation in the HSA in a way that says, hey, we are going to move everyone into a high deductible health plan, no employer contribution. We're shifting that cost to the employees. That's something anyone could do, right? Like you can put in a high deductible health plan and just shift the cost from an employer to an employee. That's less attractive as an organization to us. And so we were able to get that increase in enrollment, the savings on the premiums, and really put forth a strategy that protects our employee base and our goals. When we think of, first time adoption on an HSA, normal first year enrollment in an HSA when an employer starts offering it is about 15%. And on average, it's 20 to 30%. So for us, within 12 months to now hit that 55% move in adoption to the HSA is something that we are really, really proud of from our employee base. And we're proud of it, not just because it creates savings for our company, but proud of it because we are able to provide really great benefits that will help our employees. And it sets a stage for 2023 to continue to build that multi-year strategy where we'll leverage the tools that we use with our clients today to really create some solutions for our own employees that continues to make sure that we're combining health and wealth in providing really great benefits. And so, as I think of, I worked with Chris, our consultant extraordinaire, on this process to really build out this structure. It's really one of the exciting things, I think, and differentiators in the market to have that multi-year strategy. So.
Yeah, great point there on the multi-year strategy, Rosa. And I would encourage all of you to talk to the consultant that you're assigned to, whether it's the renewal consultant on an existing case with us or a senior consultant on a case that's new to the difference card, maybe a case you're trying to win. In either of those situations, I think building out this multi-year strategy for a customer can be really attractive, shows that you're bringing a proactive approach to the table and helping to differentiate you and your agency versus the competition in the market. So definitely a great takeaway. Talk to your team out there, and I would love to present these types of strategies to your customers and renewals as well. Taylor, I'm going to go to our last slide here, but why don't we take a couple of questions? I think we've got maybe 5 minutes to do that before we end and just talk about our next webinar. There's one that I know came in the Q&A. I just typed up an answer to Elliot. So Elliot, thanks for the question. Good to hear from you. And his question was, what's the difference between an HRA and a MERP? It's a very common question we get from a lot of the consultants and brokers we work with. Health reimbursement arrangement. The main difference between the two is that a health reimbursement arrangement has to be fully funded by the employer. Now, they're both Section 105 plans, but a medical expense reimbursement plan, a MERP, is got some characteristics that are more similar to a self-funded plan in that it can be funded by both the employer and the employees. So when we talk about a strategy of buying one underlying base plan, like this $7,000 deductible, and building back to two different options, right? The HSA approach and that 90/10 co-insurance plan, well, you need to use the medical expense reimbursement strategy instead of the HRA in order to achieve that type of result. And Difference Card can do both. We have HRA clients, we have MERP customers. The MERP approach is typically more of a customized plan design and allows you to have that core buy-up type strategy. All right, another question that came in through the chat a couple of times was, can I get these slides and can I get the recording of the presentation? And Taylor, I think you addressed that, but we do send around the recording and the presentation after, usually within a couple of days. This goes out to the participant list. Is that right, Taylor?
Yes, exactly. So I love that you guys are so engaged that you want to take this presentation that you've seen today and go share it with your team or rewatch it to get ideas and strategies. So yes, we will be sending around the recording link to everyone that attended and even those that weren't able to or had to jump off early. And please share it with your team. We would love for you to do that. And Chris, it looks like before we wrap up today, we do have one more question that came through the chat. I'm not sure if you or the Q&A.
Yeah, this is another good one. This is from John, and his question is, some carriers load the rates if employers fund more than a certain amount of the deductible. That is very common, right? Across the country, carriers don't want you fully funding the deductible without accounting for it. Well, that's really where our wellness strategy comes in. And we've worked closely with Cigna and lots of other carriers to show them that we have a wellness strategy that tries to lower claims over time. And it's not just about fully funding a deductible. We're not doing that in a way that doesn't help and address those long-term claims trends. So by using that wellness program, and that's something that sign up for one of our next webinars, we're going to be talking about that. I think that's the December topic. And we'll really highlight how you can use the wellness strategy to negotiate with the carriers and get those loads removed. Now, not every carrier is going to drop the load completely, but for example, we're seeing, say, a 4% load and that going away if the carrier buys into wellness and if the customer is agreeing to use our wellness incentive strategy. So that's really on the topic of wellness incentives that we'll address in a couple of webinars, but great question, John.